every time a new narrative came, we got a 10x in market cap and population. We went from millions to tens of millions to hundreds of millions. So the next narrative will take us to trillions.
One of the most popular questions I always get is, can we expect another altcoin season?
11 million tokens were issued last year. The tokens that are going to survive are the ones that something in the operation of the system is connected to the monetary policy.
Are we betraying our founding ideals?
You're typically going to go off-chain into a cartel. And that cartel is Wall Street, the very people Bitcoin was trying to escape from. Privacy is like waterproofing. Once the water gets in, it destroys your carpet. It's going to be radically different if it's somebody trying to hide their Tinder profile from their girlfriend versus a nation state like the United States trying to hide its targeting data from the Iranians. That's why we built Midnight.
What keeps you so passionate about crypto when so many other OGs are jaded or pivoted to something else?
We can live in a world of custodial wallets, panopticonic finance, where everything you do is tracked and traced forever, or we can live in a world of total decentralization. My job is to get us to the fork in the road and give people a choice.
Welcome to the Verify podcast by Bitcoin Suisse. None of the discussed is financial advice, of course. It's all for informational and entertainment purposes only. So sit back, relax, and let's dive in.
Welcome back to Verified. Today we have the absolute privilege to host Charles Hoskinson. His name should be familiar to anybody in the industry. He's co-founder of Ethereum, founder of Cardano, and also Midnight, the new Cardano native privacy blockchain. Charles, welcome to Verified. It's great to have you here.
Thank you for having me on.
Awesome. Let's do this.
Let's kick off with a look into the rearview mirror. 2025 had this huge divergence between fundamentals and price, really surprised to the downside compared to probably all other asset classes, including equities and precious metals. Although it was a very nice setup if you think about this, like this Trump era optimism, institutional flows, stablecoin traction, tokenization, prediction markets, you name it. Instead, the asset class decoupled to the downside. In your view, how do you score 25?
Well, the fundamental challenge is that we had a lot of structural issues with the Trump administration. The leadership style is very impulsive and it's very inconsistent. And so you have this situation where they'll say one thing and then nobody really believes it. And then when it does happen, it's a little different than what they say. For example, we're going to do a reserve and we're going to buy all these cryptocurrencies. Well, maybe it's now a Bitcoin-only reserve, and then maybe we're not going to do the reserve and these things. So there's a lot of whiplash there. So initially, there's a great degree of optimism because we went from an adversarial government, which was actively trying to destroy cryptocurrency. It was suing all the exchanges. It said everything's a security. It was doing everything in its power to damage the industry, to a government that embraced crypto. And initially, we got a lot of great wins. Like Paul Atkins became the chairman of the Securities Exchange Commission. Already the fruit that's been born is the 68-page guidance they released last week, which says ADA is not a security and Tezos is not a security. And they said where it's just a 180-degree turn from where Gensler was at, where they said they were securities in the lawsuit against the Coinbase. So that was very optimistic and positive. The passage of the Genius Act was very optimistic and positive. But when they went to more complex things, like what should a security look like in the 21st century, or the market structure bill for cryptocurrencies, this is where you need real leadership and coordination and the ability to bring people together and have a global approach. And that's been a historic weakness of the Trump administration. They're very good at the small stuff, impulsive stuff, like they can go and bomb Iran, and they're very good at blowing up 15,000 targets. And then you say, okay, what's the strategy? Like, what are we doing with this? Where do we want to go? And they say, we'll get back to you. So 2025 was much reflection there. The other thing is the broader macro, there's a ton of geopolitical uncertainty. Yeah. There's this AI bubble that's looming. It's not if, but when. You have tariffs that have come all around. And everybody believes we're headed towards a recession. They're just trying to figure out what that actually means, and whether crypto is going to be a bull product or a bear product. Is crypto going to be something that's connected to disposable income, in which case during a recession it pulls back? Or is crypto a hedge against the recession, in which case it goes up during the recession? There's no market clarity. for these types of things. There's many opinions. The asset classes that did do well, like Bitcoin, for example, that's because the institutions bought Bitcoin, and they bought them through structured products that they could buy as securities. What this means is there's no value leakage. The prior retail-driven Bitcoin surges, people would go from $250 Bitcoin to $20,000 Bitcoin, or $4,000 Bitcoin to $68,000 Bitcoin. What do? You sell some of your Bitcoin, then you buy altcoins with it. So you have a Bitcoin going into altcoin play. Well, you can't do that when you're BlackRock's ETF. It's a single asset class, and so it captures the value there. And of course, Wall Street was Wall Street, so they overdid it. They went from one structured vehicle to many DATs. They pumped them up, collapsed them down. So we had DAT mania in the second half of the year, and that destroyed a lot of retail excitement because they would buy shares. The shares would be trading above the collateral behind them. They would collapse, and then they would be trading below the collateral, and they lost all their money. And of course, Wall Street short sold and did leverage longs on the way up and down. Citadel probably made more than $20 billion, if I had to guess, on the entire DAT mania. So a lot of that. And then the president interfering directly in the markets didn't help at all. The first thing that he did when he became president was launch Trump coin, and he's got world liberty. And there's a perception that while we have this jubilee, because Trump has entered the market, it's going to become overly politicized. And the opposition party, which will likely be back in power at the end of the year, is going to try to punish crypto for the sins of Trump. So a lot of people say, well, we're headed into a recession. There's an AI bubble coming. The jubilee that we have right now for regulation is not going to be sticky. The government failed to get a reserve. It failed to get the Clarity Act passed. I should be pessimistic instead of optimistic about the market structure. I think that's probably the primary narrative for 2025 and why we didn't see a bull market.
I think that's like a super top-notch wrap-up. Fully agree. And I like your way of framing how capital is kind of ring-fenced in these like institutional structures, kind of trapped within ETFs and also these DAT vehicles. Maybe segueing a little bit deeper into this like institutional notion, that right now there's this like major change in ownership. I think right now we are inching closer to 20% of the Bitcoin supply being in the pockets of ETFs, public companies, but also governments. Do you, in your view, is there a tension between this institutional adoption and crypto's original ethos, for instance? Like, are we kind of betraying our founding ideals? Is there some kind of notion of institutions somewhat soft capturing the space? How do you see this?
No, because at the end of the day, Bitcoin does nothing. In the Bitcoin community, they hear this, and they get very angry about it, and they huff and puff, and I say, okay, how do I issue an asset on Bitcoin? How do I vote on Bitcoin? If I hold the Bitcoin, do I have any governance say? Do I have proof of stake and consensus? No. So in other words, it's a value-carrying asset. So it's like digital gold. And that's fine, but you have to accept the fact that somebody else has to run the revolution. Somebody else has to figure out how to do the dApps and the DeFi. Somebody else has to figure out how to build a decentralized economy. Okay, because just having digital gold doesn't make a decentralized economy. How do I convert it into that? So it's actually a positive thing having large actors enter in through Bitcoin, because at some point they're going to want yield with that Bitcoin. They say, well, I have $1 billion in this asset, and if I could lend it out and I could do DeFi things with it, maybe I make 5%. That's $50 million a year. It's not small money. So they need Bitcoin DeFi, and that's how Bitcoin then leaks into the broader ecosystem. So we're chasing that with Cardano, and Sui is chasing it, and others are chasing it like Solana. But it's the biggest growing vertical by far, and it's where most of the TVL growth is going to come from. Is taking all of the innovation of the cryptocurrency space with Web3 and DeFi and dApps, these things, and making it available to all that value that's locked up in Bitcoin, and it gets there. Thus, then the question comes, do large actors have influence and control over the Web3 stuff? Do they control the dApps? Do they control the layer ones that are hosting all that infrastructure? And if the answer is yes, then we have a problem. And that's what they're trying to do with these Fedi coins. When you look at ARK or you look at Canton or these other networks, these really are invitational clubs. And they're built out of necessity for a new business term. I like calling it Web 2.5. It's kind of like a Web 2, but they have Web 3 elements. Like when you look at Binance, it's a great example, or Tether, that's a great example of that. So Binance is an exchange, but they also have BNB, and they have Aster, and all these things that they're kind of working with. So there's a Web 3 component there, but there's definitely a Web 2 business with 400 million people, and it's regulated. Or Tether, where you trust a centralized entity, but Tether trades in decentralized networks. So Web 2.5, it's not being well served at the moment with Ethereum and Bitcoin and Cardano and these other ecosystems. So they're building their own chains to take over. The problem is Web 2.5 is where all the users are. There's 400 million users with Binance, and they use it every day, and there's tons of traffic there. Tether, $1 trillion of trading and turnaround on a regular basis. And where people are accepting crypto in their everyday life, like we have employees in Argentina, they don't want to be paid in the peso. They want to be paid in USDC or Tether, mostly Tether. And there's over $100 billion of cryptocurrencies in a $700 billion economy. So 1 out of every $7 in their economy is crypto in Argentina. But it's not Bitcoin, and it's not Ether, it's stablecoins mostly. So these Web 2.5 companies are the ones that have the customer relationships, and they're the ones that are currently operating at scale. And they're most likely to create permissioned federated networks that don't have non-custodial wallets and everybody's KYC'd and this type of stuff. And that's the real danger. Not BlackRock is accumulating 10% of the Bitcoin supply. Bitcoin doesn't care about its ownership class. It doesn't have any special provisions for it like Ethereum does. The bigger concern is where the users are at, and how the users use crypto is mostly through a highly curated, regulated, and custodial lens, where a third party is being that bridge, and those parties have no incentive to decentralize fully. They have kind of merged Web 3 and Web 2 in a way to create these Web 2.5 businesses, and they're wildly profitable. Like Tether buys sovereign levels of gold on the markets. They bought more gold than I think Poland did, and CZ is now richer than Bill Gates. So these are not small affairs. This is where the value creation in the industry is at right now.
Sure, it's an interesting perspective. So do you think that what you frame as like 2.0, which includes chains such as Arc or Tempo that just went live today, I think, also Canton, what we saw in the previous years was basically that the private blockchains basically completely failed, if you think about JP Morgan and all of these different experiments. So do you expect Tempo and its peers to be successful?
Well, I took the other side of the bet. I mean, Midnight is, in my view, the best home for Web 2.5, but yet we're like Ethereum or Cardano, where we're completely open and the goal is to be decentralized. So long term, I think actually your intuition's right that these chains are high entropy and they tend to fail because the things you have to do to maintain them are fundamentally uncomfortable for large regulated oligarchical businesses. So they keep trying to reinvent this. They're being a bit more successful because they have control over assets that the consumers want to have. The stablecoin is the skeleton key of the ecosystem, and that is what creates the liquidity, the lubrication, and that's ultimately what creates the on and off boarding. And the closer to the bank account, the credit card, and the legacy payment systems you can get with the stablecoin, the less friction you have of moving between legacy assets and Web3 assets. And once you're in the stablecoin, then you can go anywhere. So they have a unique advantage that Fabric didn't have and Corda didn't have, because while they were federated and they had these backbone of controllers, they didn't really have an onboarding ramp for consumers. Yeah. And also they were built in a way that was very hostile to consumer onboarding. They're like, well, Onyx, for example, with JP Morgan, they only wanted to deal with interbank transfers and they had no retail component, whereas Circle does. And that's their whole business line and how they make all their money. So there's definitely some discussions there. The other problem is Web3, to compete, has looked more and more like a federated network. When you look at Solana, it's not an open club for running Solana nodes, okay? It's not like you could take a Raspberry Pi and you're a 16-year-old kid in mom's basement. You say, I want to be a Solana node operator and actually participate in consensus. This is a multi-million-dollar affair to run these Solana nodes. And so while they're technically decentralized, the way the system is constructed, there's an economy of scale where very few people can participate in that. And that's a big problem. So our industry has to figure this out. Vitalik's solution is to accept infrastructural diversification using proofs. So you have these snarks and starks, and you do all these things, and you could verify things about other people's infrastructure, and you don't necessarily need to run the smart contract on the Ethereum infrastructure. That's how he's bridging this whole thing together, and he has a nice decentralized backbone. Other people are saying, we're going to have everything, batteries included. We have one chain, one view of it, and we control all the on and offboarding, and we're going to do that through Fortune 10 companies. So you already have the Google wallet, you already have Apple Pay, you already have a Chase account. We're going to directly hook them up and then make it a seamless user experience, kind of like what Apple does with their stuff. And so you just click a button, it uses this default thing. You don't even know you're using a cryptocurrency or cryptocurrency rails, and those rails will be owned and operated by an oligarchical federation of invitation-only companies. So, there's a completely decentralized way to do it. There's a completely federated way to do it, but this is the battle for the soul of the industry right now. And if we're not careful, within 5 years, the federated people will win by default because they have all the users. They have billions of customers. When they build a wallet into Android or into the iPhone, instantly 1 billion people have that. And if it has a default, easy-to-use experience that's safe and fast, it's very hard to compete with that on principle. Be like, well, we're more decentralized. It's like, what the fuck does that mean? Nobody knows how to measure it. Who cares? Yeah, exactly right. That's the challenge.
Well, for me, it's not a real competition. It's not decentralized solutions versus centralized solutions, because I think they approach two completely different problems. In the sense that decentralization is extremely hard. Doesn't come for free. It's much easier to take shortcuts. It's much easier to succumb to centralized forces. The only way for decentralization to win is to provide something that is impossible with a centralized solution. That's why, in my opinion, Bitcoin won, because solving double spending problem and have real digital money was just impossible with a centralized provider, because it's inevitably getting captured and corrupted. It just doesn't work. There is no central alternative to what Bitcoin provides. And the same for me is privacy, and we'll get there, because what's the point of providing privacy with a centralized provider when you're basically just trusting them with your secret? That doesn't make sense. So it's another field, another league completely.
We could talk about privacy. It's not a light switch. It's a very different thing. But with respect to Bitcoin, I'd argue to make Bitcoin scale and work, it hadn't been centralized. If you take a look at the ownership of it, the control of the network via the mining operations, how people hold their Bitcoin, they're typically using custodial wallets. We're typically using large $500 million plus data centers that are owned by a small group of actors, using subsidized power and ASICs. And then you take a look at the preferred way of owning it, acquiring it. It's through securitized products on behalf of some of the largest financial institutions in the world. So while the network is decentralized and no one can debate that, the actual use of it and the growth of it has primarily come from figuring out how to securitize and centralize and curate it in a way to make it safe for consumers. And the problem is Bitcoin doesn't provide any hooks or tools to make that easy to do in a decentralized way. Our arguments when we were on the big blocker side or the programmability side is if you make Bitcoin more useful and you add more programmability to it, it's easy to preserve the decentralization as you grow from 100,000 to 1 million to 10 million to 100 million users. By not doing any of that, all Bitcoin does is create value, digital gold, like a store of value, but then to make it scale and useful, you have to then go off chain. And you're not going to go off chain into another decentralized system. You're typically going to go off chain into a cartel. And that cartel is Wall Street, the very people Bitcoin was trying to escape from. So it's a victim of its own success in a certain respect. And it's been deeply frustrating because it's hard to intellectually engage with people on the Bitcoin side about this problem. They just say, no, everything is a shitcoin. Only Bitcoin is the standard. And I say, yeah, but is it really Bitcoin if all the Bitcoin is under the custody of trusted financial actors? You have to KYC to use it. You can be frozen at any time by a regulator or taken from you by a regulator. And also, all the people verifying the blocks, they consolidate to 10 or 20 large mining cartels who eventually will be under OFAC compliance, and they'll add a meta protocol above it for mempool censorship to basically blacklist any transaction that goes to Iran or North Korea or these types of things. And it's easy to do if you only have like 10 or 20 major miners. And by the way, they'll use environmental policy to control the miners, because those miners have to have enormous amounts of electricity to be able to make blocks inside the system. So what they can do is say that comes with terms and conditions. You have to do certain things, and you can't hide. With proof of stake, I can hide. It's a virtual resource, and you can move it instantly anywhere in the world to a different server. With mining, once I spent $500 million and built a giant data center, and I've wired in megawatts of power, I can't just go lift that up and say, you know what, I'm going to go across the border and move that whole thing. That's like 6 months of planning, and then I got to find another place. It costs millions of dollars to move the resource. So once the resource is anchored, there's no way to get around that. And the challenge is that you can't intellectually engage with the Bitcoin people about any of these things. They say, that's just not a problem at all. It doesn't exist. You're a shitcoiner. You're just saying that to justify your shitcoin and, you know, and dump your tokens on everybody. Oh, by the way, we can't wait for Wall Street to come in and pump up the token price so we can sell our Bitcoin for dollars. You know, it's not logically consistent. Now, with respect to privacy, Monero, Zcash, all these other guys, they've spent a lot of time making privacy like a light switch, where they say it's private or not private. And I say, guys, privacy is like waterproofing. So I have this watch here, and it doesn't say it's waterproof. It says it's waterproof under certain conditions and in a certain amount of water. So maybe 10 meters or 30 meters or 40 meters. So when you look at privacy, it's the exact same way. So either it's private for an individual, for a business, or for a nation state. The things we're going to do to try to de-anonymize your information is going to be radically different if it's somebody trying to hide their Tinder profile from their girlfriend versus a nation state like the United States trying to hide its targeting data from the Iranians. Okay, this is radically different. So the techniques you'll use for privacy are all encompassing. Just like the waterproofing, if you're in Florida and you have hurricanes all the time, the things you have to do to make sure water doesn't get into your house are really different than Arizona. That's a desert, and there's not a lot of rain, or Dubai. And so you're going to use network anonymization techniques, secure hardware like confidential compute, multi-party computation layering. You're going to use a different type of operating system. You have different access control. You have multi-sig. You have sharding of data. Well, does that make sense? Well, it makes sense if I'm a business and I'm trying to hide something. That doesn't work for an everyday consumer. 45-year-old carpenter just doing construction work. They don't know how to do that, and they don't want to do that. So if you're going to do privacy right, you have to create a toolbox and almost make it like the ChatGPT of privacy. The magic of ChatGPT is it's a black box for a very complicated thing. It has an API, there's an input, there's an output, and it gets increasingly sophisticated over time. Started with text only, and then it did text and images, and then text, images, and video. It could start understanding complex PDFs and documents, and you can operate on them. But the concept is still the same. I send a request in, I get an output out. So privacy's got to work that way. Then other people were building trusted hardware, like Ledger and Trezor, for storing your keys or these things. So they're building it right into the GPU for AI workloads or the CPU, but it's not programmable enough so that regular people can use it. Or zero-knowledge systems. Most of those were built for scalability. You have to have one coherent philosophy of how you pull these different systems together, just like you would with waterproofing. You have some people, you have the tar, you have the plastic, and you have the shingles, and you put it together in just the right way, and then you have confidence that the water can't get in, because privacy is the weakest link. It doesn't matter if you're using these really powerful cryptographic primitives. If you have a small back door somewhere, I'm going to get in through that. And then once I'm in, I get everything. Just like once the water gets in, it destroys your carpet. It doesn't care if it gets in at the top of the roof or through one of the side walls with a little crack. Water finds a way to get in. And privacy is much the same way. So you need a holistic strategy of pulling all those different pieces together. And every one of them does a different thing for a different task. And it's always connected to the user. Are you an individual? Are you a business? Are you a government? what are the consequences of this being de-anonymized? Will you die? Like if you're gay in certain countries, or you're a spy and you'll get captured and tortured and murdered, will you lose a lot of money? Like Toyota collaborating with a Chinese car company, if they do it the wrong way, their intellectual property gets stolen, or Google collaborating with others and their chip designs get stolen for AI, or are you an individual where if you lose your privacy, it creates a problem in your relationship, or you get your identity stolen and then people can get credit cards in your name or other things like that. Like if your social security number in the United States gets stolen. You start from that perspective and then you have that box of solutions, and we basically tell you how to do it. We make it simple, and then you pay in any currency you want. You can pay in a stable coin, you can pay in Ether or Bitcoin. This is really what we're trying to solve with Midnight, and it's been years and years and years of work, but to me it's the only way to do it. If you try to solve it in piecemeal, you're going to leave a gap and the water's going to get in, and the carpet gets ruined.
I think privacy will be or is a big narrative that can drive more adoption and demand for tokens. One of the most popular questions I always get is, can we expect another altcoin season? I would like to know your perspective on this, on what was missing last year, what can happen to drive another altcoin season. One can say that there was no real narrative for people beyond institutions, because institutions will not invest on the tail end of tokens, but rather BTC and Ether with ETFs. So for the other people, the narrative was missing. There was also a lot of frustration on tokenomics, like maybe trying to take better care of supply and demand, stop printing tokens for rewards or reducing issuance, try to find some value accrual mechanisms and wrestle with regulations to make it work. What do you think can get better, and will we have another altcoin season?
Yeah, what people are starting to realize is we have too many tokens. 11 million tokens were issued last year, and obviously the vast majority of them did nothing, and they've over-diluted. The tokens that are going to survive are the ones that something in the operation of the system is connected to the monetary policy, and so it creates natural demand for the token. So if you have an app coin, and by using it, the protocol revenue purchases the underlying instrument, it donates it to the treasury or burns, this creates a circular economy and the value goes up. I had dinner many years ago with Ned Scott, and he was the guy who started Steam with Dan Larimer and others. And we were at Smith & Wolinski over in New York, and we were eating our lobster and our steak. And I said, I really like Steam. It's a really cool platform. It has a lot of mainstream appeal. It's very smart. But here's the problem. There's a lot of demand for the influencers and writers to sell the token, but why would anybody buy the token? And he hemmed and hawed, and he said all this stuff, but he never really got there. And I said, if you could connect the token to ads, then it would be a circular economy, because basically people will buy the token to connect to the eyeballs on the platform. So I have a non-speculative reason to consume the token. So you have to look at those circular economies of there's a reason for a person to buy, there's a reason for a person to sell, and if you have a lot of adoption, it goes up naturally. So GameFi is a good example of this. There's a lot of reasons if the token is connected to the gameplay of a person to want to consume the token that have nothing to do with speculating on the token going up. If you can find those circuits, then you have something sustainable. If you can't find those circuits, in general, you're going to be in a situation where after the speculative surge dries up, you have a slow heat death and the token basically goes down. So one of the reasons why Ethereum has staying power is that there's a lot of utility inside the network. And so there's a lot of natural demand for the Ether. Their big issue is they don't have a buyback with it. So what ends up happening is there's a ton of value leakage into the layer 2 and into the other dApp coins that are inside the system. And they're starting to realize that. And it's very frustrating for some of these projects. I think Polygon has more TVL than market cap. So they're like, look at all this utility, look at all this use in the system. It's not reflected in the token price at all. Or Tron, they minted like $1 billion worth of stablecoin the other day on the platform. Normally when that happens, you have a huge boost in token price. Well, look at all this adoption utility. It stayed stagnant at around 28 billion for a bit. So the economics and tokenomics have to change, and I think they have to be connected to the revenue side. the people who do that are going to do very well. And we've been looking at a lot of options with Midnight, for example, of how to make that happen. And we have a lot of products where we're trying to align that. One is RealFi, for example, with the RFG token, because we think that'll create a natural demand cycle based on the operations utility of the system. But more broadly, to make it really go up, you have to have a narrative. That's what Ethereum brought to the space, and that's what the third generation with Cardano and others brought to space, and that's why we had a $100 billion market cap, and that's why Ethereum has a $300 billion market cap. So where's the next narrative? Well, the narrative is really three things. You have to have rules, simplicity, and safety. If you don't have those three things, you're not going to get 1 billion customers. When you talk to everyday people, you guys are exchange, and what's the number one thing they always tell you? I don't really feel safe using crypto. I'm a crypto founder. I built 4 blockchains, and I still do the test transaction thing and send a small amount and say, did you get it? And we go back and forth and everything because we're so paranoid that something bad is going to happen, and there's no backseas with it. So it's not safe. People are always trying to steal it, and they're getting so clever. Like the other day, a friend of mine got a letter in the mail from somebody representing themselves to be Trezor, the company, saying, hey, some of the Trezors have been compromised. You need to update the firmware. It was a fake letter, and if you'd followed the link, they would steal all your crypto. But they had to socially target these people, write letters that were very convincing and very, very, they looked official, and send them. I mean, this is how creative the thieves are getting. So when people think crypto, they think, God, I'm walking into a war zone where either I'm going to screw up and lose my money, or a thief is going to steal it from me, or the protocol is going to get hacked and all my money is going to be taken. And then in terms of simplicity, okay, think about the user experience of Web 2. Google it. What does that mean? You go to Google and you enter something, you click a button and stuff comes back. ChatGPT, you go to ChatGPT, you ask a question, stuff comes back. Crypto, welcome to crypto. First you got to pick a wallet. What's a wallet? I don't know. And then you got to create a wallet. Then you get 24 keywords. What the hell do I do with these keywords? I don't know. Write them down, but securely. How do I do that? Well, that's it. And then how do I use crypto? Well, you have to buy it to use it. Okay, so where do I get the crypto from? Well, you got to go create an exchange account over here and then link your bank account. In 3 to 5 days, you'll be able to get your crypto. They're like, oh, okay. I got to go through compliance. I have to share my passport. What the fuck? Okay, so you got billions of consumers on the Web 2 side, and their user experience is just go to the website, just download the app, and you can use it. And on the Web 3 side, you have this massive cognitive overhead for people and all these steps. And if they screw up any one of them, everything gets stolen or lost with it. And that's the user experience right now. So that's why mainstream adoption hasn't happened. And then compliance side, smart compliance rules. Okay, I want to put all these assets into the system. Some of them are commodities, like Bitcoin and Cardano. Some of them are securities. And if it's a security, there's a higher regulatory burden. So how do I do the KYC and AML in a fast and efficient way and make that global? So how do you do rules on a blockchain? You see, so you have to have these three things together, and it turns out they're connected to privacy. The things that you would do to make it a simpler user experience expose more personally identifiable information if you do them the wrong way. So if you have privacy built into the system, then you can do those things quickly, the abstraction stuff, chain abstraction and count abstraction, and it works really, really well. And if you want to move between regulated and unregulated products and comply with local laws, you need the smart contracts to understand that. You need on-chain identity primitives to be able to do the selective disclosure and these other things, but you need privacy for that to be safe for the consumer and it doesn't get consumed. So you can't escape that. You have to have the triangle. It's like the new CIA. There's confidentiality, integrity, and availability as like the old InfoSec CIA. It's the new CIA. You have abstraction, compliance, and privacy. Those things matter, and they are all interconnected with each other, and it's really important that they're all present. The fact that they're not is why we haven't gotten billions of users. Once they're there, billions of users can come in. That's a new narrative. It's a new generation. It's the next Ethereum when you look at that. That's what's going to bring $10 trillion of value into the space and get us to the next bull market. So I've seen it before. I've been in the industry 15 years, and I remember the old Bitcoin days, and the only way to do anything was to fork Bitcoin. So we then got Litecoin and Freycoin and Feathercoin and Peercoin, all this other stuff. And they really weren't that innovative. There really wasn't much there. Then we got the second generation. And then we had smart contracts. We had all these different ways of doing it. fixed function smart contract like BitShares, and then Ethereum full purpose NXT, Neo, all these guys that were running. And eventually Ethereum won that fight. Then we have the third generation, new narrative. You needed scalability and interoperability, on-chain governance. So you got the Tezoses, the Algorands, the Solanas, the Cardanos. Every time a new narrative came, we got a 10x in market cap and population. We went from millions to tens of millions to hundreds of millions. We went from millions of dollars to billions of dollars to tens to hundreds of billions of dollars in terms of valuations when we looked at these things. So the next narrative will take us to trillions, and it'll take us to billions of users. But to get there, you need abstraction, compliance, and privacy, and everybody's trying to figure it out their own way. Some people are trying to be very batteries included, so you have these oligarchical Fedi coins like the Cantons and these others, and they're catering to the Web 2.5 audience who already have the customers. And other people trying to upgrade their infrastructure, like Ethereum, to get there. And then other people are building purpose-built infrastructure that's decentralized, but it serves everybody. Now, that's what we're doing with Midnight. And every generation, there's a different strategy. Some of these strategies work really, really well. Some don't work out. And it's a reset, and all the customers move accordingly. I'm old enough to remember when Solana was a dying ecosystem. Now they're the promising ecosystem. I'm old enough to remember that XRP's days were done. Now I guess they're the standard. I'm old enough to remember when Cardano was the number 3 cryptocurrency and everybody loved us and they said we're going to flip Ethereum and God, maybe even Bitcoin. And then now they say it's a ghost chain and does nothing. This industry changes very, very quickly. Stuff goes up, stuff goes down. And if anybody tells you that they have it solved and they're a monopoly and nobody's going to win except for them, they don't know what they're talking about. It's a narrative-driven, generational-driven ecosystem, and every new narrative or generation brings a 10x of users in, but they require fundamentally new capabilities inside the system, and you have to solve a new set of problems. Ethereum solved a huge set of problems Bitcoin decided not to solve and recuse itself from, and then the third generation solved the scalability problems. We can now operate these systems with millions of users and do billions of transactions very cheaply and very efficiently. So we solve these problems generation by generation. Now we have to solve the abstraction, privacy, and compliance problem.
Revisiting your view on revenue, I fully agree that it should be linked a little bit more closer to the token valuation. However, what we recently saw in terms of data is basically that 90% of the revenue right now is captured by applications, while 90% of the market capitalization is captured by basically L1s. So there's a huge kind of gap between how the market is valuing applications or basically L1s. Do you think that where's the monetary premium coming from in layer 1 blockchains? And do you think this will compress or adjust and basically translate more into applications that actually capture the largest share of revenue? Or what's your view on that?
I mean, here's coin market cap today, March 18th, 2026.
Yeah.
What's the only coin that's up? Hyperliquid.
Exactly.
So everything else is the layer 1 under the old economics. Hyperliquid's under the new economics. It's up. It's gone from number 30 to number 10 in a very short period of time. In bear markets, if the protocol directly participates in its own supply and it contracts and creates demand for the token based upon protocol revenue, that's a great way to go. The layer 1 value capture is a legacy concern. Mm-hmm. So the legacy concern is there was a huge amount of investment up front for narratives, and now they're kind of coasting on that investment for narratives, and they've accumulated large treasuries, and what they do is they use those large treasuries to kind of keep momentum in the ecosystem. And there's no greater example of that than XRP. It's number 4 on CoinMarketCap, and I think the Ripple company has more than $10 billion worth of XRP. So they can keep that XRP as the standard going as long as they want to, and they can go buy a prime broker, and they can launch a stable coin, and they can do all kinds of things. But none of that is connected to any demand of XRP. What DApp and DeFi ecosystem do they have? They have none. You can't do smart contracts on XRPL. And they always talk about, next year we'll be able to do this and this, but they're not judging the valuation of that asset based upon what people are doing with it today. You see? So there's valuations are difficult, but I'd say they're mostly narrative driven. That's the layer 1 valuation capture. And then when you talk about valuation growth in a bear market, there has to be buy demand. And if there's no buy demand, the price leaks because there's just sell demand. As you finance things and do things, the early insiders who got rich off of the big initial spike, they start cashing out to pay for their bills. When the recession hits, it gets even worse. So you need circular economies. You need a reason to buy the token that's non-speculative, and you need when you sell the token, it's a natural organic thing inside the system. And there's no silver bullet for this, but it's just what we're seeing. And I think the AppCoin valuations will go higher over time. And by the way, the highest turnaround in valuation in trading is Tether and USDC. These are not protocols, these are apps, and they have most of the users, and they have the most trade. And they're building chains to accommodate themselves, and they're gradually leaving the rest of the ecosystem. Like we just announced USDCX with Circle. Everyone's like, oh, well, that's not real USDC. It's like USDCX is going to be the larger of the two ecosystems. Circle doesn't want to be in the business of native protocol issuance and managing Circle smart contracts on Ethereum and all these other places. It's so complicated and there's a lot of work. They would rather own their own chain and have it be a self-serve model where people plug into it, and it creates that bridge structure between their chain and the other chain. And Cardano ecosystem is responsible for the Cardano USDCX integration, not Circle. That's the world that they want to live in. So the app chain model seems to be the big growth model that exists right now. And the app chain gives you an added lens that the use of the underlying currency or the chain creates revenue, and the revenue can be reinvested in the token, and then it can be donated to the treasury. And by the way, that creates security stability, because the problem with all these systems is they pay inflation to pay for security. Well, that's dilutive as a process. So what happens when you run out of tokens to incentivize people, or your block rewards get too low? You lose security inside the system. If you have a purchase donate model where it buys the tokens and donates it to the treasury, that can be reused for block rewards. And so you create a circular economy also for your security spend and your partnership spend as well. So you have to get to these economy flows. And if you can't get there, the speculative wave only works as long as consumers think that crypto is the next big thing. They thought that in 2021 because it was new, just like the .com revolution, in the 90s. They say, oh, yeah, pets.com is the next big thing. But then the reality of business kicks in, and the only businesses that survived were circular economies like Amazon, where it was straightforward what Amazon does. It's this big, giant, multi-sided marketplace, and they, by owning, curating that marketplace, charge a fee and have billions of customers consume it, and it allows them to build a better marketplace over time. And now we're just kind of building decentralized versions of these types of things. So, that's where I'm at. And also in terms of narrative, the next big capture is how do you get $10 trillion of assets into the system, and how do you get 1 billion users into the system? Who's going to win that is abstraction and smart compliance. And you have to have privacy at the core of the system. This will take 3 to 5 years to fully realize this generation, and it's going to be mostly speculative in the beginning. So that'll be a big value inflow. But then the people in the meantime that are going to do very well are the people who have created circular economies with app chains. And those chains the use of the chain is connected to the token supply.
I wanted to ask you, Charles, because you touched on the generations of cryptocurrencies, and third generation introduces interoperability, but yes, also on-chain governance. I was wondering, do you see this as a shortcoming? Like something like Ethereum that does not want to introduce on-chain governance?
It is essential if you want to be decentralized to have on-chain governance, because you can only be decentralized until the crisis destroys your decentralization. So Bitcoin is running into this problem. It's a slow-moving train wreck with quantum computers. So if Bitcoin does nothing, quantum computers will destroy the entire value proposition of Bitcoin. The problem is that who gets to decide how to upgrade Bitcoin to have post-quantum signatures? Because it's not just about the signatures. It's what do you do about all the Bitcoin that's been lost or people don't upgrade to the new signatures? Can Bitcoin survive all of Satoshi's coins being stolen? Can Bitcoin survive 20, 30% of the supply being taken by North Korean hackers with a quantum computer and then dumped on the market? So you'd like to force a migration and say, okay, hey, everybody has to migrate from the old signature to the new signature. Governance makes that straightforward. It creates a process for everybody to do that with legitimacy. If you don't have any on-chain governance, there's no process to do it. So the best you could do is a soft fork to add a new signature primitive, but it's optional. And then you have to forever support the insecure legacy standard, which will be exploited and the coins will be stolen. So if you have on-chain governance, it's a solved problem. With Bitcoin, it's not, and they have no solution for the problem. Ethereum has the problem of complexity. So whenever you have a high complexity roadmap, you have strong opinionation with that roadmap. Okay, so basically there's 45 ways to do it, and you got to pick one of the 45 ways. So how do you decide? If you don't have any on-chain governance, your only solution is a beneficent dictator for life. Somebody to step up, in this case Vitalik, with his foundation, with all the money and the roadmap control, and say, this is the way we're going to do it. And there's no debate, we're going to go do it this way. Otherwise, you get paralyzed in bureaucracy and you can't execute. And if you can't execute, your competitors eat you alive. They take all the stuff you're not doing, they start doing it, they steal your customers. So the very, very long path to go from proof of work to proof of stake opened a window for Cardano, Solana, and others to take a lot of customers and market share that they should have had. And the overly long window to get all the ZK stuff in and create a cohesive ZK vision for Ethereum is massively slowing them down, and opens a window for Midnight to compete and other things in that category to compete and bring things in. See, if you have decentralized governance, you can vote on a roadmap and you can say, this is the way we're going to do it. But the core of Bitcoin, if Satoshi saw it today, is going to work very similar to what he built back in 2008. Okay, well, that's not tenable when you have technology and society changes and adopters come in. So the Ethereum side is, well, we'll just basically have this figurehead, and his job is to try to go and rally everybody. But every time he does it, part of his soul dies because it's bigger and bigger, and it's harder and harder, and it's a huge fight. And at some point, he's not going to be able to do it because the beast is too large. And then the problem is that all the flaws in the protocol, people optimize around those flaws, and they don't want to give up power. That's how we got to where we got with the legacy system. Why is identity theft so bad in America? Because there's a group of people that make a lot of money about it. So somehow, some way, we can never change the ID system, even though it sucks. Why is the tax code so bad in America? Because there's all these people in America that make money off of the complicated tax code. And if we went from 1 million pages to a simpler tax code, they would all go out of business. So they purposely keep the tax code complex to the detriment of the consumer. So the problem with a large ecosystem is once people get entrenched in that ecosystem, they create cartels in the ecosystem, they prevent the ecosystem from changing for the good of the consumer. The only way you can get around this is to have a governance system to kick them in the face. You know, so they can put it trust busting, the Sherman Antitrust Act, and all those monopolies and trusts go break them up. Or a regulator can come in and stop that. That's what we do in the legacy government sense. And when the government's working well, it can force pro-consumer movements and force an evolution of a market in the right way. And when it's working poorly, it actually gets co-opted and controlled by the oligarchy, and they actually use the government tools to double down on their monopolies and give them more control over the monopolies. So if you have a good on-chain governance system, it can prevent cartels from forming, and it could add legitimacy to your roadmap.
I would like to stick a little bit with Bitcoin, because you mentioned the quantum concerns, right? And I guess it's somewhat straightforward to make Bitcoin post-quantum resilient, but there's still like 10 or arguably 10 to 20% of supply lost, or supply that will not migrate. What's your view on the end game here? Probably like high likelihood that the community will decide that it's up for grabs, let's say. And then maybe the second angle would be the big threat for Bitcoin. You know, the 20 million Bitcoin was just recently mined. We know the hash rate is also quite volatile right now. There are also some miners pivot to the AI spectrum. There are also margins are getting compressed through a rising energy cost, for instance. So what I want to get to is basically the security budget. What's your view on that? Like, say, 50 years down the line, who will secure Bitcoin once we are running out of block rewards? Because fees right now are not doing it, right? They are as low as ever, kind of. Nobody transacts almost on Bitcoin.
Well, I mean, even if it's maxed out, it's not good. It's only 7 transactions a second. So that's the problem when you have a low throughput system. the only option is to make the fees really expensive, but nobody wants to pay large fees,
No.
to your point about them being used primarily for DDoS resistance. So here's the thing. Everything that Bitcoin needs to become a dominant, incredible system has already been invented. This is not an innovation problem. We have NEPA POWs for non-interactive proofs of proof of work so that you can have beautiful side chains and a great layer 2 ecosystem with high security. We have multi-resource consensus. We invented Minotaur, so you could layer proof of work with proof of stake, and then you could have a balancing act and decentralize the control of the network dramatically. Legal processes, like escheatment is the term we're looking for here. That is the solution for the quantum issue. If I rent a storage locker or I get something from the government and then I die or I don't pick it up for 5 years or 10 years and stop paying my storage fees, the government has the right to take it and do something else with it. That process is called escheatment. So if you have these Bitcoin accounts that are just sitting on the network for years and years and years, and it's very clear they're going to get stolen, it's very natural. What you'd do is you'd set a window and say you have 3 years or 4 years to upgrade, and otherwise it goes into a protocol treasury. Okay, and then it gets to be either reused for block rewards or it gets to be spent if you have an on-chain governance system. They don't want an on-chain governance system, so just redo the block rewards and pay them again. So the block fees go up, you get more security inside the system, more sustainability. It's very easy to do that, but they won't do that because there's no source of legitimacy to propose that. So the only solution they can put forward is to add, but they can never change. So they can add a new signature scheme, but they can't force a change in the operation of the protocol to everybody. And that works until it doesn't. And then when it doesn't, it destroys confidence in the system. Because the thing about Bitcoin is the only reason Bitcoin is valuable is it's big. Not because of what it does and not because of what it is, but it's big. A lot of people use it, a lot of people hold it. So your perception of the other person's view of the value of Bitcoin is what keeps it going. But the minute that some other asset comes along that flips it on CoinMarketCap, Bitcoin dies. Because that other asset is more likely than not going to have similar properties to Bitcoin in terms of deflationary monetary policy and all these other things. But then it does all this other stuff in addition to it. And so then people say, well, why am I using this legacy thing? The other thing is more valuable and it does more, and it also has more sustainability built into it. So there's an arrogance there because of first mover advantage, and you see it in any monopoly. You saw it in Microsoft in the 90s when they had 94% of the market, and they lost all their monopolies because they were too slow to change. They lost the Internet Explorer monopoly, they lost the Windows monopoly. You know, it's funny, they wrote a memo in 1998 at Microsoft Research. They call it the Hallelujah memo. It's the greatest memo of all time. Bill Gates asked his team, what's going to be big for the next decade? And they wrote this thing, and they said 3 things are going to dominate technology in the next decade. Mobile computing, search, and social networks. And inside the memo, they outlined the business model of the iPhone, Facebook, and Google. So Microsoft, the largest technology company in the world, knew the future. They had $600 billion of value. They had 94% of the market. They owned the web browser with Internet Explorer. Yet they still, despite knowing the future and having all those first mover advantages, fucked it up. And by 2010, the iPhone existed, Facebook existed, and Google existed at a scale. And they collectively were a larger company than Microsoft. So first mover advantage and monopolies in technology, they mean very little. Consumers are fickle, value is fickle, and if your only thing is we're valuable because we're big, that does not survive long term. It has to be that you have to look at the trajectory of innovation, and you have to say, okay, what will keep this ecosystem relevant and innovative in the long term? So when you look at Google, for example, they're always in the conversation because they have the right people, processes, and procedures for innovation culture. They fall out with AI for a little bit, but now they're right back in with Gemini because they had internal mechanisms to recognize when the strategy was wrong. And within a year to 2, they could pivot and reorient the company, and they take advantage of their scale. Like, why is Google winning AI? Because they have all YouTube, so they have all the videos, they have all the search results, they have all your Gmail emails. They have this massive corpus of data. And they also invested heavily into operating on that data with tensors, these TPUs, tensor processing units, so they can have their own supply chain and they don't have to buy from NVIDIA. So they pay 1/3 to 1/2 the compute cost that their competitors pay. They don't pay for the data, and they got 3 billion customer relationships. So they got the initial strategy wrong, but the fundamentals of competition were good. So they were able to pivot and get back to being a dominant player. Well, Bitcoin has all these built-in advantages. They have regulatory clarity. They have 550 million users. They have institutional adoption. They have governments that are okay with it, central banks that are okay with it. The bread is great. But what they have to do is they have to get to an innovation culture. The problem is they don't have a founder to rally like Ethereum does with Vitalik. And they have a culture that is a religion, which means you can't change the Bible. You can't go in and say, well, actually, I don't like that story with Moses parting the Red Sea. Modern audiences, they're just not going to like that thing. Let's change it a little bit. Maybe he crossed a bridge. Nobody will believe the parting of the sea. You can't do that. It's doctrine. It's holy books. So anything Satoshi did was holy, so we can never change it. We can never talk about it. And so what that means is eventually you're going to lose your monopoly, because eventually somebody's going to figure out the silver bullet to compete around. And what they'll do is they'll extract your value systematically. Bitcoin DeFi is probably going to be the way. Why does the gold have to live at the gold mine to be valuable? Bitcoin leaving the Bitcoin network can be more valuable on Ethereum or Cardano or Midnight than it can be on Bitcoin, because it makes a yield while it's on Ethereum and Cardano and Midnight and these other systems, whereas it doesn't make a yield there. So if I'm a financial actor like BlackRock, I have no philosophy. I'm not here for Satoshi's vision. I have investors and I have returns. So if I can have an ETF that pays a 3% dividend, I'm going to get more investors than an ETF that pays no dividend at all. It's the same underlying asset. They just live on different networks. So you're going to see a wave of structured products that are going to come in that offer yield on Bitcoin at a higher risk category, tranched, and they're going to live on different things. Well, half or more of the Bitcoin is now on other networks.
Yeah.
What is Bitcoin exactly doing? Because the Bitcoin's now living somewhere else. The gold has left the mine, and it's now processed into jewelry. It's no longer sitting as bullion, so it's doing something else. So you got to understand that that's the nature of competition. And if you look at things from a historical lens, that's the thing. That's why we focus so heavily on protocols that get more decentralized over time naturally. When you look at Ouroboros, it does that, solve the blockchain dilemma. And we focused on governance because then we'd have a backbone to move in one direction. Whether it's right or wrong, who knows, but we have clarity on that. So we never run into this quantum problem of we can only add, but we can't change. And because we can't change, we know we're going to sleepwalk into a catastrophe that's going to result in 20 or 30% of the supply being lost. We actually have a way of resolving that early design problem inside the system.
Well, the thing with
I know it's a
Bitcoin,
lot.
that's huge. But yeah, there's so many questions and points on Bitcoin specifically. This is becoming then a Bitcoin podcast. The thing is, Bitcoin is changing. It's just very slow. But then if you zoom out with the idea that this is going to last centuries, then maybe it's not that slow. And for me, one very important point is, why didn't we see this already? Because there was the Bitcoin layer 2 narrative, or the idea to unlock this capital that was idle on Bitcoin. And we didn't see that much. And for me, it's just because there is no real technical solution to have this trustless, trust minimized bridge to go from Bitcoin to a layer 2 and back.
Right.
But maybe, maybe we will see that once covenants are enabled, OpCat, OpCTV, other solutions. There are people working on it, and it will eventually happen. There was a lot of effort on BitVM, BitVM2, BitVM3 to make basically optimistic rollups on Bitcoin. I still think that's happening eventually.
All the Ethereum people started in Bitcoin. Vitalik Buterin was working on color coins and Mastercoin. I did the Bitcoin education project. We were all Bitcoin people. And then we left Bitcoin because we could not upgrade it. There was no path to upgrade it. Roger Ver tried to upgrade it with big blocks. Nothing. He left. Mike Hearn left. Gavin Andresen left. All these OGs, they left because they would run into the same problem. We get to a point where we need to change something, not add, but change something, or change the way the protocol works in some way for the benefit of everybody, and it's nearly impossible to get that in. So it upgrades, but it upgrades in a way where it says, yes, you can add, but it has to still operate the exact same way that Satoshi operated it in 2009. This is one of the reasons why Windows lost competitiveness in the 2000s and 2010, because they were trying to maintain backwards compatibility with Windows 95 and Windows 98 and Windows XP. And the challenge is, like, software has moved on. Software moved to multi-touch, and software is now mobile in nature. It's highly networked in nature. That was not the case with a little mouse cursor on a computer not connected to the internet in 1995. And so you say you have to be backwards compatible with both these paradigms. You create a bad user experience and massive maintenance overhead with the system. So then Microsoft tried to overcorrect, and they went to Windows 8, which was a touch-first experience, and it was an unmitigated disaster. So then they got so much trauma from it, they had to regress back to the Windows 7 days, and they've been stagnant. And as a result, every year they lose more and more market share to Android and to Apple. And now when you're a new app creator, Windows is often the last platform you deploy to, as opposed to the first platform that you deploy to. They've lost so much market share. So technology rhymes. And when you want to look at where do we go, you have to look at what happened before. You have to go to the past. And you say, okay, who was big and who's no longer big? Who started simple and got big very quickly? Who created staying power? Who didn't? Like, NVIDIA is a very smart company. What are they betting on right now? You see Jensen comes out and he's talking about lobsters. OpenClaw. He said OpenClaw is the most magical thing in the entire world. It's so great. It changes everything. OpenClaw is the biggest threat to SaaS that has ever been seen. Because at the end of the day, SaaS is like this model where you pay a certain amount of money per month and you get about 70% of what you need done. And the other 30%, you have to just figure it out. OpenClaw, you just tell it what you want, it figures it out. And you don't need SaaS or anything. It just builds it on demand. And the smarter it gets, the more capable it is there. And if another one of the open claws has figured out how to do it, it'll just tell your bot how to do it. And then it's like this collective swarm intelligence. Why is NVIDIA betting big on it? Because they sell the picks and shovels. They're the ones selling the hardware that OpenClaw will move. You want your OpenClaw to run locally. So they have Blackwell and all these other platforms to do it. So that's why they're pushing hard with NemoClaw and these other things. So if you're a SaaS vendor and you see this thing coming, what would your governance do? We have to change the way we sell our products. These subscription models aren't going to work anymore. We have to figure out a way to embrace it and do something like Salesforce with Agentforce, for example, that Mark Benioff is pushing aggressively there. How do you do that in a decentralized protocol with no governance and no leadership? You can see the problem, you can understand the problem, you can know the solution to the problem, but you can't fix it because there's nobody who has enough political power to resolve it. So we saw the problem. Sidechains is needed for Bitcoin to expand itself. We came up with a solution, non-interactive proofs of proof of work, which require no meaningful changes to Bitcoin, just an awareness that this thing exists inside consensus. So a small hard fork, but nothing that violates the monetary policy or Satoshi's vision. Everybody agrees it's a good idea, including the Blockstream people, because they created something called Flycoin or Flywheel or something, I forget what they called it. That was a derivative of NEPA-POWs. But it's not been implemented. It's been 9 years. 9 years, okay?
It's a tragedy.
2017. And because there's no governance to do it. Governance is the single most important part of competitiveness in these protocols, in my view. That's why Cardano focused so much on it.
Yeah, there is no governance, but there is this belief that, can just fork the code and the market decides. That's one thing. And the second is ossification is seen as this big value proposition. When you mentioned that Bitcoin is big and that makes a lot of its value, that's true. But it's also all the history and the fact that it's ongoing since 16 years and it's working. You don't want to touch it too much. I think the idea by now with ossification is that it will not be modified unless strictly necessary. So quantum risk will be the test. And from that point of view, I really am just curious about how do you see this risk? Do you have a personal assessment of timelines, how urgent it is to be ready with post-quantum crypto? What's your approach?
When you look at the quantum computing threat, what I look for is who has the highest incentive to care. Because that person, like a prediction market, is most likely going to be the one who has an accurate answer. So the two actors that care the most are the militaries and intelligence agencies. Because if quantum computers exist, the first group of people to get them will be nation states, and the nation states will use them to fuck over other nation states. So if you're a military or intelligence agency, you have to be very accurate in your diagnosis of when is a quantum computer going to come and when can it break our cryptography, because it's life or death for the nation state. So where does the U.S. government go for its big brains people for the military? Well, there's one organization. It's called DARPA. It's a great organization. And let me show you a little something. So DARPA created a great program called the QBI, the Quantum Benchmarking Initiative. And basically the goal of the QBI is to determine whether it's possible to build an industrially useful quantum computer by 2033. And so what they've done is they've broken it down into kind of three different stages. And stage A is to describe a utility scale quantum computer concept. B is what the R&D plan needs to look like. And C is to verify and validate whether that computer is going to work by 2033 or not. So they started this program last year, and they've already gotten a bunch of results out of it. Yeah, so these are all the ones like Alice and Bob, Atlantic Quantum, Atom Computing, Dirac, Google Quantum AI, Hewlett Packard, IBM IonQ. So what's cool about this is it gives you kind of a measuring stick based upon how they're graduating, what they're doing, of how feasible it is by 2033, and also what approaches are going to get there. Like Xanadu, for example, is following a photonic quantum computer approach, whereas others are doing trapped ions, and then others are doing, the topological quantum computer, like Microsoft with the Majorana fermion. So all of these have trade-offs and they have benefits, but what this program is doing is bringing everybody in the same room and talking about how do you benchmark it, how do you talk about it, and also what types of problems you could solve with these things that would indicate you have a working computer. So given that they're making forward progress, my belief is in the 2030s, probably the second half of the 2030s, we will have working quantum computers at scale in the commercial side, which means the first half of the 2030s, we will have working quantum computers at the government side in secret labs at massive scale with billions of dollars. So what does it mean? It means we've gone from a hypothetical to a mid-horizon urgency of upgrading a cryptocurrency to be quantum resistant. And there are three stages to the upgrade. The first stage of the upgrade is checkpointing. You need to preserve and protect your history. So you create post-quantum checkpoints inside the system that even if a quantum computer existed, you could reconstruct history in a reasonable way. So you first put your post-quantum stuff into your history preservation, your proof system, and your consensus layer. The second phase is having a hybrid system where you have a post-quantum and a pre-quantum system, and they run in parallel with each other. And the third phase is the migration, to go ahead and migrate to a complete end-to-end post-quantum system. The third phase of migration, there's no governance system to compel migration, it's achievement. So you have to live with both systems basically in parallel. And this is the fundamental issue. So Vitalik has a great plan for post-quantum migration. They're doing Starks, which are post-quantum by nature. They have the hash-based crypto, the beacon chain stuff, and all these other things that they're doing on the consensus side. They're gradually moving all of that to a post-quantum structure, and they have a model to do that. So phase one will be done very well. Phase two, they're already doing. And then the migration is easy for them to do because they can upgrade their ledger. We're building Midnight as a native post-quantum system. And we're going to learn a lot from that we can backport into Cardano. It's one governance action to initiate a hard fork for Cardano. So it's very trivial for us to build all these things and put all these things together and make that done. So I'm not worried about it from our side. And we worked with NIST, our scientists, on the post-quantum standards. We know all the people in the business. We have lattice experts and other people inside the ecosystem, and we're just following it. Why haven't people migrated over already? Because the post-quantum primitives are more expensive, and nobody wants to be the first mover to move to a less competitive product. You don't want to say, hey guys, I have just added post-quantum signatures and they are 10 times larger and they take 10 times longer to validate. What you've done is you've gotten a system that runs at 100 transactions a second and made it run at 10 transactions a second. The post-quantum signature does the same things as the elliptic curve signature. So you don't add any new features or any new competitiveness or new capabilities. You've just slowed your system down by a 10x. That's why there's been a laggard in the adoption of these technologies. And by the way, that's another problem for Bitcoin. If the signature scheme is 10 times more inefficient that they have to migrate to be post-quantum, and they're operating at 7 transactions a second, they're operating at 0.7 transactions per second as a system. So you have to make the blocks bigger. And we tried to do that. And it led to Bitcoin Cash, because apparently networks have not grown in capability since 2009, and hard drives haven't grown in capability since 2009. It's so stupid. It's so stupid. Back in those days, I wrote a blog post. I said, why don't we connect the block size to the growth of storage capacity in the network and create a formula just like we do with the halving with blocks and the difficulty retargeting. So the block size grows organically based upon those capabilities. And as they grow, the block size grows. So you always get more TPS inside the system. No, we can't do that. It has to be frozen at what Satoshi set it at. We can't change it. And then we lost half of our people. We lost Roger Ver, we lost Mike Hearn, we lost Gavin, all these people over that fight. And they said, don't worry, the solution is SegWit. That'll somehow magically solve everything. And it's great. It's like, okay, great. And did that give us Lightning? And did that give us a great layer 2 ecosystem? There's 90% of all the blockchain transactions happening in the Lightning network. Tether started as a Mastercoin project. Yeah. All of Tether's traffic could have been on Bitcoin in the Lightning network if they had done it the right way. Yeah. Not on Ethereum. And look at the volume on that thing. The entire DeFi ecosystem would have been nested there because that's where the stablecoin is at. And they lost it.
Maybe, Charles, could you, because I feel like quantum in combination with privacy chains is also an important topic. Could you just briefly elaborate what it means? You mentioned that Midnight will be post-quantum resilient and private transactions will stay private. But what does it mean, for instance, for chains like Zcash?
Zcash has to upgrade and modernize. They're based on Plonk and Halo 2 using elliptic curves. And so every part of it has to be rebuilt. Right now, we have a Plonk Halo 2 system for Midnight at the base chain, but then we're going to test our post-quantum stuff, bring it over time, and then migrate everything to Nightstream. So any chain that's using legacy primitives will have to upgrade to a privacy system within the post-quantum world, of which you have lattices and you have hashes to do that.
And what does it mean for transactions that already happened? Can you reveal them?
Yes. And not only that,
so that's a huge problem, no?
Massive problem. So that's why you have to create some sort of system to invalidate the old proofs and require an upgrade path for them. And if they don't, then you have a huge issue. So it's the same problem that Bitcoin has, where you even if you have parallel systems, one system's vulnerable, the other system is not. You're only as strong as your weakest link. And actually in Zcash, it's worse because what Zcash does is it's like this big black blob, and you don't have any ledger per se. When you spend, you're giving a proof that you're a member of that blob. Mm. You don't know what the address is. You don't know who you are, any of this stuff. You're just saying, I'm part of that blob over there. So if you can forge a proof, you can always forge a proof that you're a member of that blob and spend everybody's money, potentially double spend and all these other things. It's very pernicious. Yeah. It's a very problematic thing. So you have to kind of have a post-quantum strategy pretty quickly if you're going to be in the zero knowledge space. And it's, by the way, one of the reasons why a lot of people on more conservative chains like Bitcoin didn't want to move into that space, even though they were actually ahead of everybody else with things like bulletproofs and these types of things. They had done amazing research on that. And a lot of people say, why don't we embrace it so we get more privacy in the system? They say, well, the problem is you're kind of stuck in your legacy system if you have no upgrade path and you take all the trade-offs of the zero knowledge technology. And the first days of zero knowledge technology, they were special purpose circuit specific, which meant they only did one thing, whatever you wrote the circuit for and whatever the proof system did. So you had you hand wrote the circuit, which was super fucking painful, and then it would run on something like Groth 16. And then you had a very primitive arithmetization. R1CS was the first arithmetization. So that worked great for a fixed function special purpose transaction, like what happens on XRP when you send something on the ledger, or what happens with Bitcoin when you send something. But when it's programmable, you need arbitrary circuit design. And that's what we solved and Zcash solved. They wrote a paper called ZEXE, which is yet to be implemented on Zcash. And we wrote a paper called Kachina, which is what Midnight is bringing, which added programmability to the system. So you could actually write custom circuits, compile them, and then they run. So you can have arbitrary programs run, private smart contracts run on the system. But then there's all kinds of questions about upgradability and scalability and composability and all these other things. It's much more intricate than just saying it's private smart contracts. We have a pretty good strategy for how to bring those things through. Other people are kind of struggling with that because it's very challenging. Like Mina tried to bring this with recursive snarks to bear, and it worked until it didn't. And now they're kind of building a new protocol. They're migrating, and this programmability is starting to become increasingly vogue. Like Aztec is trying to bring it into Ethereum, as are others. But again, it's a very complicated thing. There's a lot of moving pieces to it, and there's no canonical philosophy. It's not like just use this and everything's okay.
Yeah.
And then we're going to compete by the consumer experience. There's still open questions about the infrastructure of what is the right approach. And we haven't even agreed on the mathematical approach, which is really, really frustrating because, the problem is that whoever wins the math fight gets the hardware optimization. Mm-hmm. If you are AES in your Apple computer, there's specialized circuits in that chip to optimize block encryption, block cipher encryption with AES. And it's in the Intel chip and everything else. If you're an alternative cipher scheme, you might be better, but it's running in software only, not hardware optimization. So it's 100 times slower than the stuff that's inside that thing, which is frustrating because you're like, okay, innovation stops when standardization happens. So typically you wait for the mathematical primitives to solidify because you know that that's the approach to take. And that's where we're going to go. And that's where all the optimization is going to be. But the primitives have not solidified. So we're building the experiences, setting the standards at the same time as changing out the mathematics. It's been a very frustrating last 5 years trying to deal with post-quantum resistance.
I can imagine. And I guess, given the duration of this recording, you can derive that we really enjoy the conversation with you. So just briefly touching the AI topic, because it becomes increasingly more relevant to society. We talked about timelines for quantum computing. Maybe could you share your mental model on AGI or even ASI with us, and what is the expected impact on labor market, for instance? There are substantial concerns. What's your perspective on that field? I guess you have a strong opinion.
I mean, it's a 45-minute answer, right? It's a big question.
No, keep it short, please.
Yeah, exactly. That's the problem. That's why I'm trying to figure out how do you say something concisely. It goes the whole gamut. First off, what are LLMs? Are they just giant imitation machines like Cyril's Chinese room and they pass the Turing test but vacuously, or are they reasoning systems that over time learn and grow and adapt and change, and they're capable of emergently doing things? So that's like the basement argument is the nature of what are LLMs, and is consciousness a prerequisite, or can you use a Dennett-style zombie and you don't care? Then one level up is what makes them useful. So setting the hard problem of consciousness aside, what types of things are you going to do with those things? And where you're finding AI is getting its biggest penetration is in automating boring stuff and in development. And so you have code generation and boring stuff automation. The problem is a huge part of business is boring stuff. Excel spreadsheets, GitHub commits, marketing materials, PowerPoint presentation generation. When I look at any large scale organization, like a big chunk of the people at that organization, all their job is to do is push paper along in every bureaucracy. So if AI automates all of that boring stuff, and it never gets any more intelligent than that, just that layer, you're probably looking at a 20 to 30% reduction in white collar jobs, across the economy and the spectrum. Now, going up one level is emergent complexity. If AI is able to do more interesting things, like it actually come up with strategy and vision, and it gets creative and these capabilities, then you're not only automating the boring jobs, but you're automating then the senior management, the executive layer of the system. So what a lot of people are talking about is the one person unicorn, $1 billion company with one employee or a small group of employees, and 99% of the stuff is just basically automated inside the system. So they're running agent swarms, and those agents do all these various things. The first flirtation with that is OpenClaw. When you look at it, one guy wakes up And he's like, I'm just going to create like this lobster robot. And it's great. So he creates Claudebot, and it's the fastest growing open source project in history. OpenAI has already acquired the developer, but the project persists. And now everybody's starting to build stuff on it. And one of the derivatives, Moltbook, was acquired by Facebook. So that is starting to be like a proto one-person company where an agentic swarm or some sort of new mode of collaboration forms, and you're able to go from nothing to an equivalent level of commits to what the Linux kernel has after 30, 40 years of development. It's pretty crazy when you think about it. AI is only going to accelerate that. Andrew Ng is a big AI guy, and he, about 2 years ago, did a lecture in Silicon Valley where he talked about a checklist of things that we have to do for AI to start emulating human workflows and intelligence. They need long-term persistent memory. They need the ability to use tools. They have to have self-refreshing context windows. You have to, in a cheap way, be able to do inference. There's a checklist of all these types of things. Almost everything on that checklist, we've seen exponential progress. The model context protocol. We now have protocols for payments. We have great agent-to-agent communication protocols. Inference costs are about 1,000 times lower relative to the same unit of intelligence from when Ning made that presentation. When you look at Claude Code and Codex and how they've come together in Claude Cowork, it's become a great coordination layer for agentic swarms, and they've grafted onto legacy concepts like Git work trees or these other things. So all those things are working really, really well. And then that ability to self-correct is another huge component of it. So vibe coding or vibing gets you like 80% of the way. And then usually what ends up happening is you get stuck in the other 20%, and that becomes 95% of all your work. Well, the AI is starting to realize it's getting stuck there, and it has this concept of recursive self-improvement. So you see that with Ralph or other things where they create these context loops, and they're able to basically start systematically chipping away and working at it. And what's crazy is there's a petulance in AI. So Wikipedia, for example, and I love picking on Wikipedia because fuck those guys. But Wikipedia, for example, they wrote this guide because they don't allow AI contribution to Wikipedia of 24 AI smells of how to detect AI-driven writing. So then AI developers took that list and they created a Claude skill called Humanizer to basically correct the writing so it doesn't have any of those AI smells. So now you can run Humanizer on your AI-generated prose, and it won't pass Wikipedia's AI detection suite. It'll evade it and come through. And then Wikipedia updated their thing, so then they update Humanizer. So there's this amazing creativity that's there, these amazing feedback loops that are there. So long and short is, I do believe within the next 5 to 10 years, the Ning agenda will be satisfied, and all of the boring white-collar jobs are done. Okay. I also do believe that AI will be increasingly used in the value creation chain as a centaur-like model, to quote Garry Kasparov. This idea that it's half human, half machine. So I create something, I check it with AI. I brainstorm with AI, and it works with me in the value creation chain. And by process of doing that, what this eventually does is it means I can do more. So I can have 10 good ideas instead of one good idea. And of the good ideas I have, I can take them to a validation stage much further along. So we're doing this in our product management side. It used to be the product manager will write requirements, and they write a product backlog, and they write down user stories and things like that. And it's a very tedious, time-intensive experience. That's not good enough anymore. The product manager can now automate the writing of user stories, product backlog, and actually vibe code the beta himself without any engineers, and then take that completed package to the engineers and talk around how they actually want to do it. And by prototyping, it can learn a lot about the user experience and these other things. And the next generation product manager will have agentic swarms of personas around the product to use the product and provide real-time feedback and update the user stories accordingly. So you're doing your customer feedback testing, your minimum viable product, your prototyping, your benchmarking and profiling as a product manager without a single engineer touching it. So by the time you take it to the engineers, you've cleaved out maybe 6 months of product development for your very first thing. So what does that mean? It means that your engineering team is smaller, your product team is smaller. You don't have like 5 business analysts anymore, and then a coordinating project manager and all these other people. It's like 1 guy, maybe 2 guys. And then you got 4 or 5 engineers in your Vibe engineering group, and they could build a product that a 50 to 100 people would build. And they could bring that product to market in 3 weeks instead of 3 to 6 months. What they bring to market is substantially higher quality than what a normal MVP would be. And then based upon user feedback, they can iterate much faster too. So every 3 weeks, their sprints look like a 3-month sprint inside. And that's where we're at today with the Vibe engineering and Vibe coding. In 5 years' time, there'll be a 10x above that. So yeah, it's going to change everything. It already has. And I'm not an AI skeptic. I think these models will, without the hard problem of consciousness, still be able to do amazing things, because I personally witnessed it.
For me, it's very clear, and it should be clear to anyone, even if someone doesn't know you, even just from these 2 hours, that you have the curiosity and the means to learn anything, work on anything, put effort into anything. My question is, what keeps you so passionate about crypto when so many other, OGs are jaded or pivoted into something else? What keeps you in this industry, but really actively building, caring so much? Did this change since the times when you first joined this industry? Do you expect it to change still, or is there something that is really the same mission that you still believe in and see also for the next 10 years and more?
The mission hasn't changed. We want to bank the unbanked. We want to decentralize finance. We want to make people own their own wallet, own their own identity. The tools and techniques have gotten more sophisticated. The markets are certainly larger, but the mission is the same. The job's not done. Midnight will be probably the last major push I make, because at that point we have everything we need to bring billions of people into the space. We have the abstraction, we have the rule making, we have the privacy. But it's a natural extension of where we started with Bitcoin and Ethereum and later Cardano. And it's the last generation that's needed. And really, it's less about me at that point, and it's more about, will people actually do the thing? It's a time of choosing. They have to make a decision. Do they do A or B? And we can live in a world of custodial wallets, panopticonic finance, where everything you do is tracked and traced forever. Your money can be frozen at any time. You can be deplatformed at any time. Content creators saw that during COVID. They said the wrong things. They lost their entire livelihood because they got deplatformed. That's finance, if we want it to be. Or we can live in a world of total decentralization and trustlessness. So my job is to get us to the fork in the road and give people a choice. But I can't force them to choose one or the other. So we're rapidly getting there. And within the next 3 to 5 years, the decision is going to be made. And whether it's made A or B, I'm irrelevant at that point, because I've built decentralized governance, which means I'm not necessary, like Satoshi's not necessary for these systems to run. And if we lose, obviously nobody wants what we're building. If we win, I'm not needed for what happens next. The ecosystem will sort it out and take care of all that stuff. And so that, to me, feels like the conclusion of a career. I told everybody what I was going to do at my TED Talk in 2014. I went and did it. And we get to see whether people liked it or not, and where we go with that whole thing. And I'm proud one way or the other. I mean, and I've gone to 75 countries. I've interacted with tens of thousands of people. I've made and lost billions of dollars. I've built now 4 blockchains throughout my career. Every one of them taught me a ton of lessons, and I've had a chance to work with some of the most brilliant people on the planet. One of the guys who worked on Cardano was the person who created the very first internet game. His name is Phil Wadler, and he was an undergraduate at Stanford working under Vint Cerf and Bob Kahn. And Vint was the creator of the internet with Bob. And they asked Phil, hey, write a software program to test the link between San Jose and Stanford. So he wrote a computer game to test the link between it, and that became the first online game. And so the fact that I get to work with people like that is so much fun. There's no other industry where I think I can have as fruitful or interesting collaborations. But on the other hand, you take all the bad, like the Trump coin stuff and these things, and it's very painful, and it's in the greed and malice and the scams, like the 10-10 thing with the collapse of the markets last year. that's just an example of us unable to get outside of ourselves. We had a good thing going as an industry. We were starting to heal, and yet we blew it up. In 2022, we could have had good regulation. FTX blew it up. Luna blew it up. So the self-inflicted wounds is the hardest part of the industry, where we finally get momentum and traction, and then greed, malice, and avarice come in, and they undo all of it. That acts as a regulating function to say this can't be the life career where every day this is all I do for the rest of my life. But you have to pick a stopping point, and the stopping point is that fork in the road. Will people choose A or B? And we're not done yet. We have to finish midnight and have to finish the Cardano roadmap. And once it's there, then at least I get to say I tried, and we did it. We get to see what ends up happening with all that. And I'm an optimist. I believe that when given the choice, if it's a good experience, people will do the right thing and we'll get it done. They did with the internet. We could have lived in an internet where you had to use an ID to log in, and 5 companies control the whole thing, and the internet was highly curated. Instead, they chose an open web, and to our benefit, and it allowed Bitcoin to exist and all these other things to exist. Bitcoin would have never been possible if you had to ask permission to use the internet.
Yep.
Satoshi Nakamoto couldn't be private. Second, they'd be like, wait, isn't this like a private money? And isn't that illegal? You can't issue your own money. No, we're not going to let you use the network for that. But the fact that the internet was open is why Satoshi was able to do what he did, which created this entire revolution. So there was no reason for the internet to be open. It could have been closed. But the brighter minds prevailed. And I think we can do it again with finance. It just takes some courage, and it takes great vision. And a lot of people have to be in the room to make it happen.
Wow. Thanks.
Awesome.
Thanks for that. I think we couldn't end this session on a more positive footing. For our listeners, we'll have links to Cardano, Midnight, also Midnight City. Please check that out. And also everything we discussed in the show notes. If you haven't already, subscribe, rate, and leave a review for our podcast. It really helps. Again, thank you, Charles. Greatly appreciated. It was a banger episode, I can tell you already.
Thank you so much, guys. This was a lot of fun.